If you have ever seen the stock skyrocket or crash over the night after the earnings, you know how powerful this event can be. But here is the thing. Hey traders, welcome back to the Quant Quest Academy. I'm your host, Sarjoghian, and today we are diving into one of the most exciting and risky opportunities in the stock market, trading earnings reports. In this episode, we are going to break down how to trade earnings reports smartly. We will talk about the market expectation, how to analyze the setups, the concepts of the IV crash, and most importantly, the strategies you can use to profit from the market reactions without falling into the common traps. Let's get into it. Why earnings matter? Let's start with the basic. Earnings reports are quarterly updates where the companies share their financial performance, revenues, profit, and future guidance. But they are more than just numbers. They reveal how well or poorly a company is doing compared to what the market expects. And here is the key. It's not just the result that moves the stock, it's the expectations. Even great earnings can lead to the stock drop if the market was expecting more. On the flip side, a company could miss estimates, but if the expectations were really low, the stock might rally. The key point to it is that the market reacts to the surprise factor, how much the actual result differs from the expectations. Now let's talk about the rule of the implied volatility. Now, if you have watched our episode on implied volatility, and if not, check that one out after this. You know the IV plays a huge role in the options pricing, especially during the earnings. In the days or weeks before earnings, IV rises. Why? Because traders know a big move is coming, but they don't know which way. That uncertainty gets priced into options, make them expensive. Once earnings are released, that uncertainty is gone, and IV collapses. This is known as an IV crash. Even if the stock moves in your favor, if it doesn't move enough, that drop in IV can wipe out your profit. This makes earnings trading with the options tricky. You are not just bidding on the direction, you are bidding on the magnitude. Okay, let's talk about the common earnings strategies. Alright, so how do we trade earnings without falling into the IV crash traps? Here are the few common strategies. First, buy calls or puts or directional bets. High risk, high rewards. You are betting the stock moves significantly in one direction. The problem is that you are paying high premiums due to the elevated IV. Unless the stock moves a lot, you might lose even if you are directionally correct. The second, straddles or strangles, non-directional bets. You buy both a call and a put, straddle, or out of the money options strangle. You are betting on one big move in either directions. But again, because options are expensive due to the pre-earnings, the move has to be large enough to offset the IV crash. The third strategy is going to be selling options or credit spread or iron condors. When the IV is high, consider selling options because you are collecting the inflated premiums. A credit spread or iron condors can benefit from the IV collapsing. Even if the stock moves, as long as it stays within the range, you keep the premium. This strategy is often safer but has limited profit potential as well. Okay, let's talk about how to analyze an earnings setups. Before placing any earnings trade, ask yourself, what's the expected move? Check the options market for the expected moves. Use the at the money straddle price. If the options market expects a $5 move, the stock has to move more than $5 for the long options strategies to work. What's the IV rank or percentile? If the IV high relative to the history, if yes, consider selling options. If the IV is low buying the options might offer the better value. How does this stock usually react? Look at the past earning moves. Some stocks are volatile movers, like Netflix and Tesla. Others are more stable. And last one, what's the company's guidance beyond just earnings? Guidance can make or break a trade. A beat with the weak guidance might sink the stock, a miss with the strong guidance might lift it. Okay, let's wrap up with some pro tips. First, if you are new to earnings trading, start with the paper trading. Get a feel for how IB and the price react before risking real money. Second, don't chase every earnings event. Focus on the stocks with the high expected moves and liquid options. Third, consider post-earnings. Once IB collapses, options are cheaper and trends often emerge after earnings surprises. Fourth, manage risk. Earnings can gap against you overnight. Don't risk more than you are willing to lose. Okay, that's a wrap up for today, traders. Earnings season can be thrilling, but it's not for faint of heart. By understanding market expectations, implied volatility, and using smart strategies, you can stack the odds in your favor. If you enjoyed this breakdown, subscribe to Quant Quest Academy and hit that like button. Got questions or want to share your favorite earnings strategies? Drop the comment. I love hearing from you. Until next time, trade smart, manage your risk, and keep learning. Thanks for watching.